So welcome back to my channel. In today's video I'm going to tell you about that how you can make money trading smart money concepts, and I will tell you one strategy which you can use in your trading. So without wasting time, let's get started. So welcome back to my channel. In today's video I will tell you a strategy which you can use, and it has like a 70% win rate when you will practice this for at least 3 or 4 months. Okay, but in the beginning this strategy you have to work on it and you have to get in sync with this strategy. So the strategy is really simple. It's totally based on liquidity, and with this thing and in smart money concepts also, smart money concepts is also based on liquidity totally. Okay, so with the smart money concepts and with this strategy, what we do is that we look for supply and demand. Okay, and now you guys will be thinking that what, like, how supply and demand can be in smart money concepts. But the thing is, we are finding supply and demand to find out that where are the stop losses. Okay, so why should we find stop losses? So here comes the first thing, the definition of liquidity. The stop losses of lots of traders is called liquidity. Okay, so for example, if you look at over here, there was this demand zone over here. Okay, and price came into it and gave a rejection from here. You can see this candle over here. This candle was really green when it was live. Okay, but we know that people, those who are buying from here with the starting of this demand zone, their stop loss will be just little bit below of this demand zone. Okay, and what we'll do is, when we know that where are the supply and demand, so we can also assume that the stop losses will be below of this structure. Okay, and now with my strategy which I built is that you have to place your limits over here and you have to do your risk management, and you can put like 10 pips stop loss like this. Okay, you can put like 10 pips stop loss like this, and you can target another swing high like this one, because this one is also like a word, like it is like a supply zone, right? Because market gave a rejection from there, but our target would be the high of this. Okay, our target can be 1:2. So now there's two types of liquidity. Okay, another one is the liquidity grab, which has done over here, and another one is liquidity run. So if you look at closely, the liquidity grab happens when we are against of the order flow. Okay, so when we are against of the order flow, so what do I mean by that? If order flow is bullish like this, okay, so now the liquidity grab will happen when price will go down below of this low, and it will create like a fake break of structure or change in character. Okay, and then it will go up. This is a liquidity grab over here, because price went down. People, those who thought that this is a demand zone like this, they got stopped out over here. Okay, and the people, those who thought that this is a change of character, they also got stopped out when market went up and took this high. Okay, so this is liquidity grab. And now I should tell you about the liquidity run. So liquidity run is like this: when you know that the order flow is bullish, okay, now what will happen is that price will give a change of character like this, and now it will go and it will reject from the same place from where it got rejected last time, like this. Okay, it will go down, and now people will think that there was a change of character over here, and now market is rejecting from this last candle, and they will say this is a order block, like last upward candle. It's not a order block. Okay, it's like people have mixed up the smart money concepts with supply and demand. Okay, or they will say this is like a breaker block or something, like don't mess it up, okay? Just use simple terms and make it easy. So that's why this strategy is all about. The strategy which I'm telling you right now is simple, and it's very easy to maintain, and it's very easy to find out in the charts. So people will think like this is a supply zone, okay, because they can see a rejection from here. Now there's liquidity building up above of this to highs, okay. If people take sell in this leg by seeing bearish engulfing, they will place their stop losses right over here. But we know that market order flow is bullish, so what price will do, it will go and make a liquidity run over here, okay. There was lots of liquidity over here, so it created a liquidity run like this. So now understand about it, that you have to look for the liquidity grab, okay, or liquidity is like liquidity run, like you have to look for the liquidity grab whenever price goes against of the order flow, okay. So for example, if you know that the order flow is bullish like this, we can see that it was bullish over here from here, because on higher time frame, we go on 1h time frame, okay, over here we saw that price took this low. Now price will go and take this high, because what's above there, a lots of stop losses right over here, okay. There will be lots of stop losses over here. So now we can see that price has taken the sell side over here, and market order flow is bullish because we did our analysis on higher time frame. So on 5-minute time frame we are bullish, but we are seeing a change of character like this, okay. We are seeing change of character like this. So this is not a change of character, this is a false move or judo swing, which is done by big guys, and it is done because of a purpose, because they want to make people feel that it is about to fall down, okay. So but what we'll do is we know that the order flow is bullish, the bias is bullish, okay, and the short term trend is also bullish over here, because if you see that price is making like a higher highs and higher lows, but we have to see a fake lower low like this, okay, fake lower low, that will be a liquidity grab. So where we can see that market is overall bullish, the bias is bullish, and now we can see that price goes down and takes this low. So we'll place our limit just a little bit below of this structure right over here, okay, and our stop loss will be 10 pips, and or you can do whatever is your risk management, okay, you can do that, and you can place your take profit just a little bit above of this structural high, okay. So it's that simple. And now it sounds simple, but the thing is, it will be hard for you sometime to find out that what's the correct liquidity zone, okay, what's the correct order block, or like what's not the order block, what's the correct supply and demand, because it's hard to find that which supply and demand has a lots of stop losses or lots of people over there buying in or buying out. So that's why what you have to do is, like, because lots of people will think that this was the good supply, or a good demand zone, right? They will think like this is a good demand zone. Why they will think that this is a good demand zone? Because they can see market created a higher high, and then it created a higher low, and then it created a higher high. So they are thinking that there will be stop losses below of this structure, okay. There will be stop losses below of this structure, but there are more stop losses over here as compared to stop losses which are over here, okay. That's why price went down to take all of the stop losses, and then it moved back up, okay. And if you would have taken a trade from like little bit below of that structure over here, then also you would have been in profit. Like you would have taken a 1:2 trade, and trade would have gone. If you would have taken a buy over here, then you would have faced little bit of drawdown. Like it's a lot of drawdown, it's not a little bit drawdown, it's lot drawdown. But then also when market came down and took this low, you are in profit, okay. So I hope you understood the strategy. So now a thing is that you cannot use this thing everywhere, okay. There is a specific time period in a day when you can use the specific time period, which I can say that you should use it in New York kill zone, okay, after 8 o'clock. after 8 o'clock there will be a false move like this, and you can use this after 8 o'clock and every day after 8 o'clock. If you find the setup like this, just take the trade. Like over here also you can see the price created a high and high low, but it was consolidating over here because price moved a lot in Asian session. So the thing which I'm trying to say is that you should take you should look for this type of liquidity runs in New York yield zone, okay, after 8 o'clock New York time. And if you guys can see that there will be some people, those who will be really fearful to take trades like this, and because they will see these type of big candles and they will be thinking like, oh yo, it can go down, and take the stop losses. But we have to play with their fear, okay, the thing which they're, because big guys, they do the same thing. When people get FOMO, or when people get feared by the market move, there's the moment when you have to enter in the market, okay. So people will see these type of big candles and they will see this type of breakout, they will start selling because they can see that there's a big selling move coming up, okay, coming down, sorry. So that's why, but we have to do the opposite because we know that bias is bullish, okay. And now if you are a beginner in this and you are right now not capable enough to, like, you need a little bit of more confirmation. So then also you can find out the confirmation, because if you look over here closely, but sometimes prices give confirmation for the entry or sometimes it don't, okay, because it will just short towards the upside. But this time it gave an opportunity from a fair value gap. So you can see that there was a market structure shift, because this was the swing high over here. Price went up, broke this swing high, and price left a fair value gap over here, okay. It's a clear fair value gap. Price just tapped a little bit into that fair value gap and then it didn't came back, okay. It just kept on going up and it just went up and took this high. So if you're feared to place the limit, so what you can do is you can wait, and you can wait for the fair value gap, and then you can enter right over here, okay. But this does not happen every time, because sometimes what will happen is that price will go down like this and then there will be a big move and no retracement back towards the downside, and you will miss this big move, okay. So that's why, if you understood this one, and if you look it over here closely, that price is bearish overall, okay, but we are taking buys over here. Why? Because we are looking for a short-term trend, okay. The short-term trend is bullish right now till the price goes and takes this high, okay. And there will be a liquidity run, because you can see that there was a rejection from this zone over here, which is a supply zone, right? There is this rejection, and now, as I showed you in 15-minute time frame, that there was a, sorry, not a 15-minute, 5-minute time frame, that there was a rejection from here. The same thing will be happening on 1-inch time frame. It gave a rejection and now there will be a liquidity run, okay. It will go up and take this high and then it can fall down. So with this thing, you should not look for the macro trend, like we should not look for the big picture trend. You should look for short-term trend to trade on 5-minute time frame, because this is the mistake which lots of people do. They will look for the bias on a daily time frame and then they will go on 5-minute time frame to take the trades, okay. That will be complicate all the things, that it will be really complicated, okay. So that's why what you have to do is you have to go on 1-inch time frame, or like higher time frame means like 1-inch time frame or 4-inch time frame, okay. 4-inch will be a like a little bit bigger picture, but 1-inch time frame is enough to trade on 5-minute time frame, okay. Or you can trade on 15-minute time frame and you can look for higher narrative on 1-inch time frame, okay. So I hope you understood this one, and I will show you some examples also. So the another example is this Nasdaq example. So look at over here closely, that price after 9:30, you can see the time over here, it's 9:30. Price gave a lots of rejection from the supply zone, okay, and every trader in the market, they can see this type of big bearish engulfing candles, right? So what they will think when they will see this type of bearish engulfing candles from this supply zone, they will look for sales because they're thinking that price is about to fall down. But what happens after that? It's correct at like after 9:30. After 9:30 there was this false move. Okay, that's why I tell people not to trade from in between from 9:30 to 10 o'clock. Trade after 10 o'clock in silver bullet. Okay, so from 9:30 to 10 o'clock there will be a false move, and here's the example of this false move. See, and I pointed out in my Discord group also, like look at over here, I showed them when it happened, and like it went up and then it started to fall. Okay, so this goes up. Now this looks like a breakout, right? For every traders, those who are trading this, they will think that this is a breakout of the supply zone, and now this is a demand zone. And now what our strategy says, that we should place our limits a little bit above of the supply zone, and we should put like 10 points or 15, 20 or 25 points stop loss. It's Nasdaq, right? Sorry, it can be 40 points stop loss, okay, or 50 points stop loss. And then you will enter a little bit above of the supply zone, okay, and your target can be these lows or these lows over here. Okay, but the thing is, look at this. Everyone, when they will see this type of big candle, this big candle, what they will feel, just think about it, they will feel that it's a bullish move. Every trader out there, when they will see this candle in a live market, right now I'm telling you this in hindsight, right, but then they will see it in a real market, they will feel like little bit confused, because they'll think like, I should look for sell, I was looking for sales over here, but now I see this candle. So they will follow the price, they will see that this is a breakout, oh, so market is going up, so they will take a buy from here. And you can see the little bit of this type of green candle over here. Okay, it looks like a rejection from this supply zone, but it's not a rejection. It's one more time they're trying to make them fool that it's going up. No, it's not going up. It has taken all the stop losses above from here, and now it's about to fall down. Okay, so I hope you understood this one. And this one is the US dollar, USD CAD. Okay, so this is also a supply zone. Market gave a rejection in a London session from this supply zone. Okay, look at the time below, it was from 3 o'clock to 4:30. But after at 9 o'clock, okay, there was this big move towards the upside, and it goes and taps into this round psychological level of 1.37500. From a pinpoint it taps, and then it comes back, and then it starts to fall down and take all of these demand zones, people's stop loss over here. But it kept on falling. So understand about this. Okay, now people will say that there was a demand zone over here and there were the lots of stop losses over here, so why market fall down when it gave this type of big move after taking the liquidity from bottom? So why it fell down? Because the bias was bearish. Okay, you can see a short like little bit short moves from this demand zone, okay, over here below of this demand zone, when it will go and take the liquidity. But overall market is bearish, so it will give a small reflection from there, but the thing is, overall it will go and fall down. So in this scenario also, what we'll do is, we can see that there's this supply zone building up over here. So people, the big guys, they're engineering liquidity, so they will place their limits little bit above of this supply zone. So so we want to go with them. Okay, so what we'll do is, we will do the same. We will place our limits over here and like 10 pips stop loss, and we can target 1:2, right? I hope so. It's simple, and it's the same one which I explained over here. It's the same thing. Okay, it went down and took this, and it started to go up and up and up. So I hope you understood this one. And another thing is that with this strategy, this will work if you use a correct risk management. Okay, if you're using bad risk management, then it will not work. Okay, so risk management is like, what you have to do is, you have to cut down the risk when you're losing the trades with 0.5%. Okay, and you have to increase the risk when you are like making profits. So increasing in the sense means like increasing in the means, so for example you are risking like 1%, okay, and you took one loss. So when you took one loss, you cut down the risk and go back to 0.5%, okay, and you took another loss, go back to 0.25%, okay, and now you took a win. So what you have to do is you have to take trade from 0.50, okay, 0.5%. Why you increase the risk? Because you took just now, you took the win, okay, you took consecutively like 2 losses, so that's why you were risking like 0.25, and now you are trading and like you are just increase your risk because you took the win. So when you took another win on 0.5, then you can go back to 1% initial risk, okay. So that can be your risk management, and that's the risk management which I use. And why I use it? Because every trader goes with a big losing streak. So like sometimes you guys are also, I think so, you guys are also experiencing this, that what happened is like we create an account, okay, it goes like this, and then what happened is like we face a bad week or bad month. So you can, in a bad week or a bad month, you can take like 5 losses in a row or like 8 losses losing streak, because something bad is going on in your life. So this can happen. So in that 8 losing trades, okay, in that 8 losing trades, if you're doing this, if you're cutting down the risk, then you will survive, okay, because if you're cutting down the risk, so you will not blow your account in 8 trades, because you can, if you do the math, okay, you are, after losing the first trade, you are just cutting down the risk for 0.5, 2.5, and then you are just keep on losing 2.5, 2.5, 2.5, 2.5 till 8 trades in a row. You lost 8 trades in a row. Still you just lost like 4 or 5% or like 3 or 4% after 8 losing trades. But instead of that, if you would have risked like 1% on each and every trade, the 8 trades in a row, you would have lost like a 8%, okay. But over here you just lost like 3 or 4% or 2% or 3%. So that's why I use this risk management, and your risk management can be something different, okay, and your risk management is based on your what's your account size. So I cannot say anything about it, but I just told you my risk management, okay. So I hope you guys understood. So in a summary, I should say, okay, what's the strategy in a summary? That look for supply demands, okay, and support and resistance, and look for the stop losses. Assume that, okay, if I would have been trading from the supply and demand, I would have placed my stop loss over here. So now you're assuming that their stop loss can be above over here, okay. You look the first step, look for supply demands, you find a supply, okay. Now what you have to do is you have to place your sell limit where people will place their stop losses, okay. You'll just place your sell limit where the people will place the stop losses. So you will just place it over there, and then you will place like 10 pips stop loss, and you will target 1:2, okay. And now it's 50-50. It can go and hit your stop loss, or it can go and fall down, and it can take your profit, okay. So now I should say that people say that it's very hard for them, okay, it's very hard for them to find a bias or short-term trend. So I should explain you that how to find a short-term trend, okay. So do one thing, just follow the price like higher highs and higher lows, okay. Don't look for the higher bigger picture or something like that. Just look for it like a higher highs and higher lows. And now you can see that it's making a higher high. So when you will see this, just take a buy, okay. Don't think so that it's about to fall, it gave a change of character and now it can fall down, it has taken these 2 lows. No, it has taken these 2 lows because price was respecting every low, but now price went up, and like price has no liquidity left over here, so it came down to take the liquidity over here to go more up, okay. So the same thing which happened over here, price was creating higher high, lower high, lower low, lower high, lower low, lower high, lower low, and then in all of a sudden it created a higher high, and then it created a higher low, and then it created a higher high. So now what's the short-term trend in this much price data? It's bullish, right? So now what I told you, so if short-term trend is bullish right now, so wait for a liquidity run or liquidity grab. So what happened after that? Price went down, took the low over here, took these two lows over here. Okay, you'll just take a buy, you'll just place your limits a little bit below of this structure, and now just wait for price to go and take this high and see what happens. Price made a higher high, price made at this lower, another lower low. Okay, then price created a lower high, and then it failed to create another lower low. Okay, it didn't went down and took this low. Then price created another higher high, higher low, higher high, higher low. Okay, so from this you can find out the short-term trend. So I hope you guys understood, and if you guys have any questions about this strategy, because it's very simple, it's just like placing limits, placing stop loss, and just leave it alone. Okay, and just wait for the results. It's like that. And for the order flow and for the bias, for short-term trend, you can use higher highs and higher lows and look for a fake change of character. Okay, or if you want like a really good bias, if you want to know, if you're trading on 15-minute and you want to know a good bias, then you can go on higher time frame and do the same thing. Look for higher highs and higher lows and look for the liquidity grab or liquidity run. Okay, and then you can create a then you can find a short-term bias from that higher time frame narrative. That if the higher time frame narrative is bullish, then in small time frame you can look for buys. Okay, when price will go and take the low of sell side, or it will go and take the sell side stop losses. So I hope you guys understood that what is the strategy, okay, and how easy it is, and how to find liquidity. What is liquidity? Liquidity is nothing but the stop loss. So what is bias? Bias is like getting to know about what's the higher time frame and what's the higher time frame narrative, where's the higher time frame going, because we are trading on smaller time frame, 5-minute, and we understood that we should not look on daily time frame if you want to trade on 5-minute time frame. Okay, and we got to know about the timings to trade, that we should trade after 9 o'clock, after 8 o'clock in New York Kill Zone, because New York Kill Zone has a lots of liquidity over there, and like it's like a big session. And now I explained you the risk management also, and you should find your own risk management on the based of your capital. Okay, and I showed you the approach also, that how to place limits and what will be your stop loss and all. So I hope you guys like this video. So if you guys like this video, drop a like, share it with your friends, and subscribe for more content like this. So until next time, wish you good luck and be safe.